Hey everyone, Patrick here with another How To video. Today we're going to talk about how to invest in gold and silver, which has never been more appropriate because with the government printing trillions of dollars and with the natural inflation, odds are our money is going to keep dropping in value. So buying gold and silver is a good way to protect against inflation. So today I'm going to show you 3 ways to invest in gold and silver and the one costly mistake I want you to avoid. Before we start, please do me a favor, click the subscribe button and the like button. It really helps, especially for a newer channel like mine. Thank you. Now let's get started.
All right, guys. So the first thing I want us to look at is gold mining companies as well as silver mining companies, because what we really want is exposure to the price of the metal, right? We don't care about physical gold and silver. What we really want is to be invested in it. So gold mining companies and silver mining companies are one way to do it, which you don't have to keep it at your house. It's very easy because you can do everything online in your stock market account, just like any other stock. So this is a list of the top US gold mining companies. I only look at US and Canada companies, and you can just type it in Google top US gold mining companies, and you're going to get a look. I don't know all of them, right? So you'll have to do your own research on the pros and cons of each company, their assets, their management, but this is giving you a starting point. So you can do the same with silver mining companies. This is going to give you an idea of which are the biggest players in the country for gold and silver mining. And then if we go look at Barrick Gold, which is one of the bigger companies, I want us to look at the chart just to show you this is one day, but if you put it at like 1 year, you can see that the price typically, historically, kind of tracks the price of gold and silver. When gold goes up, the mining company goes up. When gold goes down, the stock goes down, which makes sense because their revenue is based on the price that they sell it for, typically. So as we can see here, March 18th, 2020 was the worst part of the pandemic, and people were selling gold and silver to get cash, pay margin and everything. So see, you can see a dip, but then it goes back up as the price of gold and silver went back up. So this is a really good way to insulate yourself from inflation, because as the price of gold and silver goes up and the value of the dollar goes down, typically the mining companies their stock are going to kind of follow that same trend that we saw with the gold and silver versus the dollar, right? So this is the first one I want you to look at, and then we'll move on to the second one, which I consider a little bit better. All right, number 2, we have ETFs. Now, if you don't know what an ETF is, the short version is that it's an exchange traded fund, which means you can basically put anything in the fund. In this case, we're going to look at gold and silver related funds, right? So there's 2 types. Number 1 is those that actually buy physical gold and silver and futures and everything. And then you also have the gold mining companies, which we just saw, but in the previous section, we were talking about individual stocks. In this case, it can be multiple companies, right? So the first one, let's look at largest gold ETFs. I've always invested in GLD, right? But there are other ones that you can look at. So these are funds that basically invest in gold and silver themselves, and you can basically buy shares of the ETF. So it's exactly like a stock. So you would go into your stockbroker account, look up the symbols, and you can actually buy shares. And then you can do the same thing with the silver ETFs. I usually use SLV. And then if we go for miners ETFs, which is another option, which is more diversified than picking individual stocks. Because when you pick individual stocks, you have to really pay attention to the management and the assets and this and that. But when you buy an ETF, you're a little bit more diversified because it's a fund that has multiple mining companies, right? So one of the bigger ones is GDX. So if you can look at the trend here, let's look at year to date. See, again, exactly the same as earlier. It's pretty stable, then follows the market when there was the dip, and then it went back up. if you look at the long-term trend, see, it doesn't really lose a lot of value. It doesn't gain a lot of value either. But that's what we want with gold and silver, is to basically keep our purchasing power. The goal isn't to make a fortune, it's just to not lose your money, right? So it's better than keeping cash. And these, since they're on the stock market, you can just sell them anytime, get your money back, and then go make whatever purchase you need. So let's just look at GLD. Again, let's look at the 1-year chart. And again, as I said multiple times before, keeps the same trend, right? So this is a better way to invest in gold and silver, in my opinion, than to buy individual stocks, because you have more diversification and you have very high liquidity. So let's jump to the third and last one that I want to talk about, which is options, which is my favorite way to invest. Right, guys, now let's talk about options, which are one of my favorite ways to invest. Today we're going to look at SLV, which is one of the ETFs that I told you about that tracks the price of silver. It's very easy to trade and it has a lot of volume, so you can do this all day. You're always going to find a counterparty. But just keep in mind, since options are a little bit more complicated, and this video is specifically about how to buy and sell gold and silver, I don't want to go into too much detail, so I'm just going to show you the two basic methods, which are covered calls and cash covered puts, right? So nothing too fancy, just the very basic. So let's look at, we're going to look at January 15th, 2021 expiry, which today, as of filming this, we're in April. So this is about 8 months from now, right? Let's just look at the numbers. Let's see what we can do. So number one, we have covered calls, which are one of the basic options that you can do. So in this case, you need to have some shares of SLV to do it. Let's say that you were to buy 100 shares, which is one contract. Today, at $14.15, you would need to spend $1,415, right? What that lets you do is sell one contract. Let's look at the $15 strike price, right? So right now it's at 181 bid, meaning that if you were to sell this person your one contract, you would get $1.81 per share. Times 100, that means you would collect $181 for your investment of $14.15. Right? So I calculated that would give you 12.7% return, which isn't too shabby, right? You're not taking a lot of risk with this. So now that's if you don't get a sign. That's if this price stays the same and nothing happens. What happens if the price goes to $16? Well, then that's the whole game with options, is you have to sell it for $15. Well, if you think about it, you just collected $181 and now you collect an extra $85 because you bought it at $14.15 and you're selling at $15. So you collected the premium and you're getting extra for selling it higher. So the return is pretty good. Now, if the price goes down, which of course is the risk, then you do have that $1.81 per share premium that you collected that gives you this padding, right? So now you're not into the shares for $14.15, then you're into it for, let's see, $12.34 total investment divided by 100. So you're into it for $12.34 per share. So you see how that works? Like, you, instead of spending $14.15, like someone that would just leave it to chance and let the market dictate what their stock price is at, in this case, you're going to make money. If it goes up, you'll make the 181 plus the 85 cents difference between the strike price and the current price. If it stays the same at $14.15, it's going to be under the strike price. So you just keep the premium. Nothing happens. You just keep the premium, which we calculated to be 12.7% over 8 months. Not bad. And if it goes down, of course, you might lose a little bit of money. But in this case, you're into it for $12.34. So you have that $1.81 per share padding where it needs to drop this much for you to break even. If it goes below that, you'll start losing money. But right now, if you didn't sell covered calls, you'd be at $14.15, so you'd lose a lot more. And of course, there's adjustments that you can make, but we'll cover that in another video. Now let's move on to puts. Right now it's at 14.15. Let's say that you wanted to sell a put, right? A put gives someone the option of selling you the shares at a certain price. This you can use to actually purchase shares under the current price or keep the premium. So let's say that we wanted to sell a put at $13 strike price. Let's say that we find that we're happy, like we're fine. We'll buy it at 13 bucks very happily, right? Well, right now the bid is at 138. So you would sell someone the option of selling you the shares for $13 for 138 per share. Now it's a little bit complicated, but just assume that you're selling him the option to sell you the shares, and for that you're collecting $138 for your investment. So let's see, you're quote unquote risking 1,300 and you're collecting 138. So right then and there, like nothing's happened and you already made a 10.6% profit. Not too bad. Again, like you're not doing anything. You didn't spend any money. You're just giving someone the option of selling you the shares. And there you go, 10.6% over 8 months. And then what happens if the price goes up? You just collect your premium and nothing happens. If the shares go sideways, you collect the premium, nothing happens. If the shares do go down, 14, 15, let's say that it's now 12 bucks, right? Well, you're buying it for 13 and you collected 138. So let's make sure that I have the math right. 13 minus 1.38, you'll be into it for 11.62. So again, like the profit, of course, wouldn't be that high, but you'd still be making a profit even if you sold the put for higher than the resulting price, which in this example was $12, right? So you're covered, you're making money 2 of 3 ways, and the other way you might break even or you might possibly lose money if you don't make any adjustments. But then you have 8 months to make adjustments. And that, guys, is the power of options. That's why I like them so much. In this case, selling puts, we're making money out of thin air, basically, just by selling someone the insurance. And again, this is all related to gold and silver prices, right? So we're just exposed to the price of gold and silver. If we think it's going up, we can sell a put. We'll just collect the premium as it goes up, and eventually it's going to expire worthless, and we'll keep the premium. If we sell a covered call, we just collect the money, and then if it goes up, we'll sell the shares, but we'll have collected all of that extra premium. So that's the power of options. That's why this is my favorite way to invest. It's way better than just owning physical gold and silver. Leave that to collectors. Like, nothing wrong with them. I have some myself that I get to display in my house, but it's not something that you want to collect and own like 10, 20, $50,000 worth, right? This is a much safer, better, more convenient way.
Now, I promise you guys one crucial mistake I want you to avoid making, and that would be to invest all of your money in gold and silver coins and bullions like these. Now, this coin is worth about $15, and that's great. I encourage you, if you want a few of them to display in your house, no problem. But there's 3 quick reasons I want to tell you about why I don't want you to do this. Number 1 is sales taxes. Yes, in a lot of states in the US, you're going to be paying taxes, especially if you buy less than $1,000 at a time. So I'm going to put a link in the description that shows you what applies to your state. Number 2 is dealer fees. For this coin, to buy it, you're probably going to spend $17 when the spot price is $15. To resell it eventually, if you were to sell it to one of the big companies, they might give you $14 for it. So you lose all of that spread. And number 3 is the safety reason. If you have $10, $20, $50,000 of gold and silver, do you really want to keep that in your house where that's the first thing that robbers would want to grab? No. So then you're going to have to either get a third party to store it for you, which obviously, or you're going to have to invest in a lot of insurance, and that's just not as convenient. For those reasons, I strongly encourage you to follow the 3 methods I showed you earlier. because they're very easy, convenient, and they'll help you preserve your money by investing in gold and silver and protect yourself against inflation. Guys, I hope you learned a little bit. If you do want to buy a few coins, I'll link below in the description a website that I've used before. We talked a lot about ETFs in this episode, so if you guys want to learn a little bit more, you can view a video here that's going to tell you a little bit more about it, and I'll see you next time.